Pretty big change in sentiment as to the outlook for a recession in our CNBC Fed survey. But let me just show you why it may or may not matter. Look at this spike we have right over here from 14.4% 2 surveys ago up to 19, now 23%. This is the highest level of the Trump presidency and one of the highest levels we've seen since 2016. I guess the good news is we have spiked up here before to 29%, and it did not result in a recession. And you can see this nice, what do you call that, a lilac or a mauve? What color is that right there? That pink line, whatever you want to call it.
Pink.
I'm not pink, you just call it pink. Okay, that's what I'm told in my ear. 19% is the long-run average. So we're above the long-run average. But let's take a look at the growth forecast, especially in light of that little tease you had before about the person who thinks we've overdone it. 3.2 is the number that we estimate we're going to do in GDP in 2018. And then what you do is just flip those numbers, unfortunately. But 2.3 with a long run 1.8%, and then here's the outlook 1.8% back to potential growth is the average forecast for our panel. And let's move on to the next screen, and I'll show you the unemployment rate, 33.7%, unchanged, inflation 2.2%. That's CPI inflation. What are the biggest risks, as Melissa asked before? 31% say it's protectionism, the biggest risk to the expansion. 19% say a Fed policy mistake. There's global economic weakness, and higher rates in general, as in higher market rates as opposed to higher Fed policy rates, are the big thing. And what about that 210 spread? Is it signaling recession? Well, only 2% say it is, 29% say it's close to there, and 64% say it is not signaling a recession. So I think this group is a little less, what would you say, concerned, sweaty in the palms than perhaps the overall market.